The Middle East war is expected to exert a modest but meaningful drag on near-term growth through renewed supply chain disruptions, higher shipping costs, and increased uncertainty around energy and trade flows. In our view, these pressures pose a greater risk to inflation than to economic growth. The April Consumer Price Index report underscores that inflation risks are no longer narrowly concentrated in one category, even if the initial impulse remains energy-led. Headline CPI rose 0.6% in April and 3.8% over the past year, while core CPI advanced 0.4% on the month and 2.8% year over year, signaling that the disinflationary trend has lost momentum. Energy was the dominant driver, with the energy index up 3.8% in April and accounting for more than 40% of the monthly headline increase, while gasoline rose 5.4% on the month and 28.4% from a year earlier. The key risk is that the Middle East conflict turns what might have been a temporary energy shock into a more persistent inflation event. If the conflict lingers through the summer, keeping oil prices elevated, disrupting shipping routes, and raising fuel, freight, and input costs, could plausibly add a full percentage point to inflation this year through both direct gasoline effects and second-round pass-through into airfares, food, logistics, and imported goods. The savings rate was 3.6% in March 2026, well below the roughly 6.5% pre-COVID-19 average, and reflects a combination of higher living costs, continued discretionary spending, and the drawdown of excess savings that had supported consumption earlier in the cycle. The key risk is that a low savings cushion leaves less room for error, especially for households already using credit to bridge the gap between income growth and cost pressures. Non-residential fixed investment was a key support to first quarter growth, helping offset softer contributions from other parts of the economy and contributing roughly 1.4 points to headline growth. In sum, business investment in tech equipment continues to boost growth. This category has more room to grow if the late 90s are any guide. Tariffs are likely to represent more of a one-time step up in the price level than a persistent source of accelerating inflation. In short, tariffs may have lifted the inflation floor, but geopolitics now represent the more material risk. Overall, our tactical views emphasize a modest equity overweight led by a large cap growth, a continued focus on quality bond sectors, caution in rate-sensitive fixed income sectors, and an ongoing allocation to diversifying strategies and alternatives. If you have questions about the stock market or your investments, contact us today at Oxroad Capital.